Hi, personal finance gang. Hope you guys are all doing okay out there as we continue our quarantine adventure. If you remember way back when we used to actually meet in person, I would start off a lot of Tuesdays with the weekend river update. So here is a quick weekend river update. I may have showed pictures of this before, but we are doing our social distancing. That's my sister up there. Safe paddle, avoiding people. Actually saw way more snakes than people on this trip. Probably a dozen snakes or so in total. And my friend who got there, who we're social distancing from as well, but got to the launch site ahead of us, saw a bear, spooked a bear in the morning. And then he was out front on the trip and spooked a big gator as well. But anyway, so this is Boiling Creek on Eglin Air Force Base. Real pretty river. I'm supposed to pull up my next picture in the line too. Where is that? So here's another shot of Boiling Creek. Again, very pretty. That's the bottom you're seeing down there. And these are pitcher plants, really pretty. These plants that catch bugs, but this is the bloom on those. A nice red flower that comes up about this time of year. But these were, thousands and thousands of these pitcher plants all over the place. Why isn't my next working? I'm supposed to be able to go on to the next picture. Here's another shot, just a picture of flowing grass there along the edge of the banks. Just really pretty, crystal clear water. You can see the bottom, see fish swimming. We saw lots of turtles, like I said, lots of turtles and lots of snakes, fish, etc. So, okay, I promised. Here's another shot of some pitcher plants and stuff along the bank. And then I promised a snake photo. Here we have not one. This is a pretty cool picture here. We don't see this. Almost never see this. But, that didn't work. So yeah, brief technical difficulty there. But this is not one, not two, but three water snakes. These aren't venomous or anything. We didn't actually see any water moccasins. But this is three snakes coiled together. You can see one head there, a second head there, and a third head there. But this is three snakes coiled together on a tree, just along the water there. Again, probably saw at least a dozen snakes. The week before saw more than a dozen. They're out in full force right now, but don't usually see them coiled together like that. And again, no snakes. We didn't see any water moccasins at all. I'm sure they're there. They just weren't where we saw them. But let's get back to mutual funds and ETFs. And this is one of the most important topics of the semester. This is going to be probably the way for most of you to do what we've been talking about, or what I've hinted at and mentioned several times: save for retirement. So even though retirement's a long way away for most of you, it's something you want to start planning on as soon as you get that first real paycheck. And the way that most of us will be saving for retirement is going to be probably through mutual funds for a while, and then ETFs if you have expanded choices, depending on how you're saving or where you're saving through. So we're going to talk about what these are, what are mutual funds and ETFs, and what are the benefits of them, what are the types of mutual funds and ETFs, and then we'll talk about costs, and we'll see why we're concerned with costs as well. So we'll start off with mutual funds, and then we'll end up with a little material on ETFs, or exchange traded funds. So first, what is a mutual fund? Basically, I've got the nice definition up there, but basically we have a company that collects money from a bunch of investors, pools that money, and then sells shares and you become part owner of a diversified portfolio of securities. So I've mentioned the S&P 500 index before. So if you buy into an S&P 500 index fund, that fund has taken the investor's money, bought all 500 companies in the appropriate proportions, and when you buy a share of the mutual fund, you're buying a part ownership or an indirect ownership of those 500 shares of stock. By law, the way mutual funds have to handle their finances so that they don't get taxed on the portfolio's returns and stuff, is they have to pass through the dividends and capital gains that they make by managing the fund. So what that means is if you buy into an S&P 500 index fund, if 370 of those companies are paying a dividend, the fund collects those dividends and then they distribute them periodically to the fund owners, who then can either reinvest them or whatever, but you get taxed on them as though you received the dividends. Same thing with capital gains. Even if you're buying and holding the fund itself could be buying and selling shares at a profit or loss, and then that would mean capital gains or losses to the owners of the fund. So those are distributed as well. But anyway, so that's the pass-through requirement for mutual funds. Now, what we get here, one thing with funds that's nice, fund families. So my favorite mutual fund family is Vanguard. So I've got the picture right up there. I've got a link to it. But Vanguard has a family of funds. And what this means is if you go and invest your money at Vanguard, you can easily move your money around, for the most part, without any fees between other Vanguard fund opportunities. And let me just grab Vanguard here and pull this over. And Vanguard, so what's a family of funds? Vanguard has 130 different mutual funds right now. So this is mutual funds, and I mentioned ETFs. There's ETFs over there, but and they're grouped in this particular list here by category. This is all their funds, list by asset class. But so they have money market funds. Remember, these are short-term, low risk. This is a place for potentially for rainy day funds. Got bond funds. We know what bonds are. If you buy a bond, you're lending money. So here's bond funds. And this is U.S. issued by the U.S. government. We'll see more on this later. Investment grade means these are relatively safe. Below investment grade, it's a nice way of saying high risk or high potential return. Tax exempt. And then something we haven't talked about, balanced funds, target date retirement funds. We'll talk about that. That's going to be an exciting category. And now I just skip down here, stock funds. So we know when you buy stock, you're getting part ownership in the company. And they have a lot of different stock funds. All those scrolling on down, the rest of the way there were stock funds. So that's just Vanguard. If you put your money at Vanguard, you can move around depending on the account type and all. You can generally just move around between all your different Vanguard funds. I can go back over there. Another fund family, another big name in funds is the American funds, and they're sorted here a little bit differently, but they've got anyway, so they've got different ways to find funds. Find your fund by fund objective, asset type, say bonds versus stock. So fixed income is another way of saying bonds, and then equity is sorry, turn your phones off. Equity is another way of saying stock. We'll talk about balanced. But anyway, so they've got, show me a number here, but a large number of funds. Some are considered growth funds. We'll talk about what that means: growth in income, equity income, balanced taxable bond, tax-exempt bond, and money market. So there's another fund family. You can move your money around between these different funds for the most part without fees. And anyway, so that's all within one fund family. And the number one advantage to investing in mutual funds is diversification. So with one purchase of however much the minimum investment is to get a fund, it differs by fund, but with one quick purchase, you could be part owner of the S&P 500 index. You could be part owner of a couple thousand different shares if you bought like the Vanguard Total Market Fund. It has, I don't know, roughly 2,000 stocks in it. So diversification. To replicate that on your own with limited funds is at best going to be a major hassle. But anyway, and most likely it's going to be impossible to very impractical. So diversification is the number one advantage of mutual funds. That doesn't mean they're risk-free, because if you own the S&P 500 index, you've got 500 stocks, you're pretty well diversified. But as I showed you when we talked about stocks, the S&P 500 has been hammered since we've been quarantined here. Or anyway, although it's rebounded quite a good bit. I think it's probably only down maybe 15%, 14% from its high as of the last time I looked. And that's after being down about maybe 30% for the year at one point. But anyway, so diversification doesn't mean elimination of risk, but you lower your risk versus having just one or a few securities. You don't have to be a millionaire or even have $100,000. You can start investing in some funds with little or no money. So you don't have to be super wealthy to start investing in mutual funds. You get some kind of professional management watching your fund, depending on you get professional management, but different funds may have different levels of management engagement. Thousands of mutual funds to choose from. Thousands of these different things you can choose. So you can find a fund to make you happy. Moving between funds, like I said, if you have your money at, say, Vanguard or American funds or Fidelity funds, you can move your money between the funds, no hassles for the most part. There are also places, fund warehouses, where you can go move your money between different fund families, and they may charge you a fee for doing so. So I just did a transaction through my retirement brokerage account, and they charged me $35 to get in a fund that wasn't one of theirs. So a $35 transaction fee, which is a bit steep, but I liked it better than their fund options. And so I've got custodial services. The funds will give you detailed statements about and tax consequence information, or information for filing taxes and such. And another big advantage of funds is basically related to one particular category of funds, index funds. So you can have funds that just, like I said, I mentioned the S&P 500 index. You want all the companies in that, one nice purchase. And I'll talk about why indexing is an advantage over having, or a potential advantage over having someone pick particular stocks for you. So yeah, you have $1,000 and you want a diversified portfolio of individual stocks. What would be your concern? Well, there are a lot of places, probably most brokerage houses now start charging zero. But if you have any fees whatsoever on $1,000, it's going to cut into that percentage-wise a good bit. And also, so you got $1,000 and you want to diversify. Let me just show you something here. So you want to get a nice diversified portfolio, and you think, geez, I should have Apple Computer in my diversified portfolio? Well, here's Apple Computer right now, $287 a share. So you got your $1,000, you got one share of Apple Computer, and they've taken almost 30% of your money on that. Then you decide, wow, I really need Microsoft too, $172 a share right now. So it doesn't take long, and you might end up with, if you're lucky, you might end up with 7 different companies with your $1,000. You can, of course, find stuff with lower stock price, but do you want to have to pick your stock based on stock price? Versus you got $1,000, you find a mutual fund that takes most of them will have minimum investment amounts. So you want one, that would take as little as $1,000, and you can get, again, like I said, diversified portfolio. And I'll talk a little bit about that later on in a different section. So you will be able to find a place for your $1,000 and get a diversified portfolio for relatively low cost, or pretty low cost. All right, so disadvantages of investing in mutual funds. Some funds, or many funds, charge loads. Basically, that's a fee to get into the fund. I don't like those. More on those later. But if you have to pay a fee to get in, I don't like it. My $35 that I had to pay was on a big dollar amount, and it wasn't a load. It was just a fee to invest through the brokerage deal that I have through my retirement account. If it was any of my regular accounts, I wouldn't have that. But anyway, it's a retirement account where you have limited choices. All funds, okay, hey, I'm in finance. Everybody in finance thinks about money. All funds are going to charge management fees. So no place are you going to take your money and they're going to go, hey, we're just happy to do this for nothing. So they're going to charge a fee. They have to make a living. So you do get charged a fee. Depending on the fund type, hey, your performance may or may not be great. There's no guarantees. There are no guarantees with investments. We know that already. Some funds that are trying to beat the market, we'll talk about that later on, may actually have what we call high turnover. So if the fund is buying and selling stock a lot, what that does is has tax consequences for you depending on what type of account you're investing through. So, the fund may show a good return, but it may end up hurting your taxes. If it's in a retirement type account, this won't matter, but if it's in a personal account, this could have an impact because, well, we don't like paying taxes, and if we have a choice, remember, we'd rather pay them later. So when you purchase and sell, when you buy and sell stock, you're buying and selling. Basically, somebody else is on the other side of the deal. Somebody has to sell. You have middlemen helping facilitate this stuff and all. But if you're going to buy, somebody has to be selling. And but that's not exactly the case. Well, that is, but not the same way here with mutual funds. When you buy and sell, you're buying and selling directly from the fund family. So if you buy IBM stock, IBM has nothing to do with the deal. There's just another investor in there in the middle, or investor out there selling. If you buy shares in the Vanguard S&P 500 index fund, Vanguard is the one selling them to you. When you're ready to sell your Vanguard S&P 500 index fund shares, Vanguard is the one buying it back from you. So they're, directly to and from the fund. That's how mutual fund transactions take place. But again, you may have some place where you can deal with a lot of different fund families, but they're just acting as an aid to get you to the different fund families and probably charging you a fee. So you may be able to open an account at Schwab and have shares in Vanguard and American. I'm not sure which fund families they deal with, but you're likely going to be paying Schwab a small fee to do that. You might just rather, well, it depends what your needs are. If you can find a fund family that has funds that make you happy, you might just go with that one fund and skip any middle person that might be charging you fees, such as my 35 bucks that I still miss. All right, now mutual funds are technically, well, they're open-ended investment companies. And the open-ended part means there's no limit to the number of shares they can sell. Sometimes some of them will close, but legally they can sell as many shares as people will buy. So what happens if right now you decide, hey, I've got to be in that Vanguard S&P 500 index fund. You send them some money, and at the end of the day, they'll give you the price of the shares. You won't know the exact price till the end of the day, and they'll create more shares of that fund. And then they'll eventually, they try to keep as little cash as possible in something like that. They need money for transactions and stuff. People get, cashing out. But they'll take your money and it'll be pooled, and more shares of the different companies will be purchased. So they're constantly buying or selling shares of the stocks they have interest in, depending on whether people are buying or selling the fund. Now, the price you pay when you buy into a mutual fund is known as net asset value. And that's just, hey, you're buying in the S&P 500 index fund, what's the value of the 500 stocks? And less any liabilities the fund might have. It's usually not much of an issue, divided by they add up the value of all the shares they hold, subtracting liabilities, divided by the number of shares they have outstanding, and that's the price they're going to charge you for new shares. This is done at the end of the day. Well, which answers this question. Can I buy and sell mutual funds anytime the market is open? The answer is no. You can place an order, but for most funds, that order is processed based on end-of-day prices. So right now it's almost 3 o'clock as I'm looking here at my computer. And so if I said, hey, I want to buy some shares right now, what I would get is the end-of-day pricing, which isn't far off. So that's the way they want. If I wanted to, if it was if it's 9 in the morning, the market's open, and I decide I've got to get out of the stock market right now, and I've got mutual funds, this is one disadvantage. We'll talk more about this a little bit later. I'd want to sell. I can go ahead and put in my sell order, but I won't get the price till the end of the day. So if the market's dropping all day long, oh well. With mutual funds, they're not designed to be quick in and out. They're more of a long-term investment. So you get the end of the day price from whenever you place your order. Let's pause right here and we'll pick up with this in the next part.